Beyond Meat, BYND, closed the last trading session on Friday, May 1, 2026, at exactly 95 cents per share, marking a significant movement from its intraday low of 93 cents to a high of $1.10. Since today is Saturday, May 2, 2026, the market is currently closed, but the energy surrounding this specific ticker is anything but quiet. While most people are looking at that price and seeing a company struggling to keep its head above the $1 mark, the reality under the surface is far more complex than a simple delisting narrative. The typical expectation here is that Beyond Meat is a fading pioneer, a brand that caught a trend but couldn't sustain the economics of it. However, the insight that many are missing is the aggressive pivot the company is making into functional beverages and the massive debt restructuring that recently wiped nearly $1 billion off their liabilities. This isn't just a food company anymore, it is a business in the middle of a total structural identity shift, moving from being just a burger alternative to what they are now calling a plant protein company with a focus on liquid nutrition and diversified retail. When you look at the general sentiment, it's easy to find reasons to be skeptical. The plant-based sector has faced a brutal couple of years with cooling consumer demand and high production costs. But if you look at the recent institutional activity and the volume spikes we saw on Friday, reaching over 113 million shares, there is a clear tug-of-war happening. Large-scale players are beginning to eye the valuation because the enterprise value has been compressed to a point where the brand name alone might be worth more than the current market cap. This creates a classic tension between the expectation of a slow decline and the reality of a potential scorched earth turnaround. Investors using platforms like Interactive Brokers or checking their Fidelity brokerage accounts have noticed that the volatility in BYND has turned it into a high-stakes battleground for those who specialize in distressed assets. Whether you are using a Robinhood app for quick trades or managing a more stable individual brokerage account, the question isn't just about the next quarter, it's about whether the brand can survive its own expansion. The daily swings we are seeing right now are largely driven by anticipation for the upcoming first quarter earnings report scheduled for May 6th. Traders are currently bracing for what could be a 35% move in either direction. This is the kind of environment where Schwab Intelligent Portfolios or a standard robo-advisor might struggle to provide the nuance needed for such a high-risk asset. If you are looking for investment help or exploring various investing sites to understand the risks here, you have to look at the volume. When volume follows price upward as it did in the recent pop toward $1.10, it suggests that the buy the dip crowd is becoming more aggressive. But the macroeconomic pressures of inflation are still weighing heavily on the consumer's wallet. People are downtrading from premium plant-based options back to traditional proteins or cheaper private labels. This is the reality that Beyond Meat has to fight against every single day. For those who are active in self-investing or prefer to invest online through a Fidelity trading platform or the SoFi active investing interface, the technicals are showing a strange divergence. While the long-term trend looks like a slide, the short-term moving averages have actually issued buy signals. It's a rare moment where the technical reality is starting to exceed the narrative expectations. The company recently launched its new buffalo chicken pieces at Kroger and is rolling out a breakfast sausage line made with avocado oil. The shift toward clean label certification is a direct response to the criticism that plant-based meats are too processed. By cleaning up the ingredient list, they are trying to win back the health-conscious consumer who left the brand a year ago. It is a risky move because higher quality ingredients often mean tighter margins, but it is a necessary gamble to stop the bleeding in retail sales. Now, let's talk about the business model for a second, because that is where the foundation either holds or breaks. Beyond Meat operates in the massive packaged foods landscape, but their specific niche is under heavy fire. They generate revenue by selling to grocery chains and food service partners like McDonald's or Starbucks. Historically, the expectation was that as they scale, costs would drop. The reality has been that production efficiency hasn't kept pace with the drop in demand. However, the recent news about their partnership with Big Geyser for a functional beverage line called Beyond Immerse is the first real sign of diversification. This moves them into the non-alcoholic beverage space, which has entirely different margin profiles and distribution needs. If you are tracking this in your SoFi Invest account or watching the ETFs that hold BYND, this move into drinks is the wild card that could either save the company or further dilute its focus. The financial restructuring is perhaps the most overlooked part of the story. Management managed to reduce outstanding debt significantly, which has extended their runway. A few months ago, bankruptcy was the primary expectation. Today, the reality is a company with a cleaned-up balance sheet and over $200 million in cash. While they are still burning money, the burn rate is being addressed through an enterprise-wide transformation. They are consolidating production and optimizing their lines in Missouri to cut down on logistics. If you are someone who likes to investigate Fidelity mutual funds or individual stocks for long-term recovery plays, this is the part of the analysis that matters most. The narrative has shifted from can they survive the month to can they become profitable by 2027. It's a subtle shift, but in the world of online investing, that difference is everything.
At this point, I want to hear from you. Comment below how many shares of Beyond Meat you currently hold, or if you have completely moved out of the plant-based sector. Do you think the expansion into the beverage market is a smart move or a desperate distraction? Your engagement helps us gauge the sentiment of the actual retail community versus the institutional narrative. Looking ahead, the catalysts are very specific. We have the earnings call in just a few days, where we will see if the revenue guidance of $57 to $59 million for the quarter holds up. If they beat that number, even by a small margin, the short squeeze potential is enormous given the high short interest that has plagued this stock for years. On the flip side, if the cash burn hasn't slowed down, we could see a return to the 50-cent lows. The expectation versus reality framing here is simple. The market expects another weak quarter with limited visibility. If the reality shows even a glimmer of margin expansion or a successful early rollout of the beverage line, the stock could retest the $2 level faster than people realize. For those using a Robinhood crypto and stock account or those deep in the Interactive Brokers platform, the liquidity is there to support a massive move. Beyond Meat has also been making headlines by becoming the first plant-based meat to qualify as a climate solution according to certain frameworks. This might sound like marketing, but for institutional investors focused on ESG and for certain Fidelity ETFs that track sustainable companies, this is a functional requirement for inclusion in their portfolios. It's an example of where the company's mission aligns with financial structures that can provide a floor for the stock price. Even if the average consumer is purely focused on price, the big money is looking at these certifications as a way to justify holding the stock through the volatility. It creates a secondary layer of support that isn't immediately obvious when you just look at a price chart on an investing site. The business itself was founded back in 2009 with a clear vision, and while the path has been anything but a straight line, the core promise of the brand still carries weight. They have survived the initial hype and the subsequent crash. Most companies in this position would have folded by now, but Ethan Brown and his team are doubling down on a beyond the plant strategy. This involves looking at the total addressable market not just as meat eaters, but as anyone looking for protein-dense, environmentally friendly options. Whether it's through a Robinhood cash management account or a sophisticated Interactive Brokers account, investors are watching to see if this broader vision can translate into actual dollars. The previous close of 95 cents is a reflection of the uncertainty, but it also represents a low bar that the company could potentially clear if their transition office delivers on the promised logistics savings. As we move toward the final outlook, we have to consider the risks of further share dilution. There is always the possibility that the company will need to raise more capital if the transition to beverages takes longer than expected. This is a risk that anyone involved in self-investing needs to weigh against the potential for a high-reward recovery. The reality of the current market is that there is no room for error. If you are managing your portfolio through a Fidelity mobile app or tracking your wealth management through more traditional channels, the high volatility of BYND makes it a tactical play rather than a foundational one. The expectation is that the upcoming earnings will be another wait-and-see moment, but the reality is that the market is primed for a reaction. In summary, Beyond Meat is a company that has pushed its way into a corner where it must innovate or disappear. We've moved past the phase where simply being plant-based was enough to command a premium valuation. Now the market demands margins, it demands diversification, and it demands a clear path to being cash flow positive. The contrast between the current sub-$1 price and the aggressive expansion into new categories like functional drinks creates a fascinating tension. If the reality of their operational improvements exceed the low market expectations, we are looking at one of the most interesting turnaround stories of the year. However, if the institutional activity we saw on Friday was just a temporary hedge, the road ahead remains incredibly steep. The depth of this analysis shows that BYND is no longer a simple buy or sell based on a burger. It's a complex bet on the future of protein and corporate restructuring. Maintain your authority by staying focused on the data, not the hype, and watch that earnings call on May 6th with a very close eye. The movement in the last session was just the opening act for what is likely to be a very volatile month for anyone involved in this stock.